John again, founder of the Wealth and Freedom Nexus website, podcast, and this YouTube channel. Hope you've been enjoying the content that I've been sharing with you. Last month in April for Financial Literacy Month, I pounded through a video, one video a day of 30 ways to get started in real estate investing. And I also want to continue to bring additional content that I've found valuable through my financial journey starting in late 2014 that I wanted to convey to others that I think would be beneficial for them as well. So I don't know if this is going to be a monthly thing. It's going to be at least a monthly thing, maybe a weekly video. I'll just see how time and everything permits. But I want to bring about a tax tip for Tuesday. Obviously, we're recording and releasing here on a Tuesday, but just a little hack of the tax code, if you will, that I myself have found very beneficial. I myself have used, as well as my wife and I have done this in our retirement accounts, bit by bit, piece by piece, over the last several years to eventually save tens of thousands, if not hundreds of thousands of dollars in taxes. So basically, high level, I'm going to be talking about retirement accounts. And I think everyone's probably familiar with IRAs, which come in two flavors, which is your traditional IRA and your Roth IRA. Now, the way the IRS sets up the tax code for IRAs is that if you do a deposit or contribution into a traditional IRA, you basically get a tax break on your contribution. All the money in the funds in the IRA grow tax-free. And then down the line, 59 and a half, 65, whatever retirement age, you choose or works best for you. Then when you take those distributions out, then you are taxed on them. Roth works in reverse, where you do not get a tax break up front. This is after tax dollars that you are contributing to a Roth IRA. But then the money grows tax-free, and then the distributions are tax-free as well. Kind of in the industry, Amanda Holbrook with Specialized Trust, she's always had the phrase tax-free forever. She loves Roths. I love Roths. I think everyone should have a Roth. And I'm going to start by, I think everyone should at least open up a Roth IRA. And maybe if you don't even fund that right away, there are some nuances in the tax code that, if you make too much money or don't have what's called earned income to show, you may or may not be able to contribute to a Roth IRA in the future. So I always recommend, as soon as you're able to open up a Roth IRA account, even if you're not able to fund it right away. However, like I said, many people are familiar with the traditional IRA, and what's been getting a little more popular. So the traditional IRA came about in the late 70s. The Roth IRA, that's actually named for the late Senator Roth that sponsored the bill. The Roth IRA came about in 1997, 1996, somewhere in there. And the 401k workplace plans, it wasn't until I think 2000, I want to say 2006, 2007, that there was a Roth 401k contribution. I myself hadn't even heard of that until one of my first jobs was working at Hy-Vee, and they had a 401k plan and they had a Roth component of it as well. So I like the concept of, hey, I put money away. I take the tax hit now. I'm essentially paying tax on the seed, but then the harvest is tax-free. And it kind of removes a lot of uncertainty, if you will. At the time of this recording, we're in 2022, in less than 4 years, barring some action of Congress. The Tax Cuts and Jobs Act of 2017, which actually lowered all the tax brackets, they're set to revert come January 1st of 2026. So if you're in the federal tax bracket of 24%, let's say, that will revert back to 28%. I believe I think it was the 12% bracket, that reverts back to 15%. Each one of those brackets will revert back to what they were prior to the Jobs Act passing. So kind of overall here, I've read a number of statistics in the whole community of retirement accounts. Something about if you take all the trillions of dollars in retirement accounts, whether they're in 401ks, IRAs, Roth IRAs, 403bs, whatever the retirement accounts, alphanumeric soup you come up with, somewhere in the ballpark of give or take 20 to 30% is in the Roth component or tax free. And about 70% is in the traditional component or what's called the tax deferred. You're deferring the taxes to a later date. Again, I don't know if anyone has an exact number on this. I'm just kind of throwing out some statistics I've heard in passing over the years. But regardless, we have the tax deferred component here and the Roth component here. Now, let's just say, I don't know, maybe you, I can name a number of investments. Maybe you have a self-directed account through, I don't know, IRA Financial or Choice Financial that allow you to invest in cryptocurrencies in your retirement account. Maybe you're one of the lucky or unlucky people, shall we say, that invested in Bitcoin, and maybe you invested through one of the big downturns. What was it, late 2017, early 2018, where it capped at 20,000, then dropped to about 4,000. Recently, I think last year it hit a high of about 60,000, then dropped under 30,000. It's come back to about 40,000. So regardless, for any investments, I just named Bitcoin. I think everyone's heard about it. If there is a sudden drop in the market, you could potentially turn this into a great tax savings. And I'm going to give it a couple examples here. So just for simple numbers, let's just say you have a $10,000 investment in your traditional IRA. And for simplicity purposes, we're just going to say the 24% tax bracket. So let's just say we have an investment in your IRA, and maybe this is a stock holding, maybe this is cryptocurrency, maybe a note fund. I mean, nowadays with a self-directed retirement account, there's quite a bit that you can invest in retirement accounts. So I'm just going to go off of Bitcoin and a couple of stock ticker symbols, kind of some movements over the last 5 to 7 years that I've seen, some I've been able to partake in, and just even talk about some hypotheticals here. I mean, obviously the old adage, hindsight is 2020, but we're just going to walk through a couple examples. So let's just say you had invested in Bitcoin and you had $10,000 worth of Bitcoin in your traditional IRA. Now, maybe with one of the severe corrections, downturns, whatever euphemism we want to use, that 5,000 drops to, or excuse me, that 10,000 drops to $5,000. So you just got smacked with a 50% loss. And the way the numbers go, if you just went from 10K down to 5K, in order to get back to 10K, you're going to have to get a 100% return just to get back to even. Now, it's definitely possible. I'm going to give a number of examples where there's been huge rebounds like that. But here we're just going to walk through some examples. Let's just say you had, I'll just use Bitcoin. You had $10,000 worth of Bitcoin in your traditional IRA. Now it's dropped to 5,000. Now you might think, oh, great. Just hit it, just had a 50% loss. It's going to take 100% gain just to get back to even. But there's a way that you can utilize the tax code to your advantage to do what's called a conversion. Now, this is pretty easily done within the IRA, family, so to speak. If you have an account with, Fidelity or Vanguard, Edward Jones, just to name a few, Ameriprise, maybe a self-directed player, Specialized Trust, Quest, Equity Trust, IRA Financial, just to name a few that are out there. But at any point, you are able to do what's called a conversion. And basically, you're telling the IRS, I am going to move, and we're just going to use these round numbers. I have these holdings, or I have this cash, or I have these stocks or securities, or whatever the case may be, that is currently valued at $10,000. I want to move that $10,000 of holdings to my Roth account. So now the 10K is over here. 10K from a traditional IRA, 10K to a Roth IRA. Now with that, the conversion, there's going to be a tax hit. Now I recommend working with a CPA, certified financial advisor, maybe your tax accountant, tax attorney, someone that can walk you through the steps of your individual scenario. Because, depending on timing, everyone's tax situation is different. This might even trigger, you bump you up into another tax bracket, pay higher taxes. Maybe the alternative minimum tax comes into play. There's a lot of nuances in the tax code. So I'm not just giving blanket advice. I'm not giving financial advice out here for, by any stretch of the means. I just giving this out for educational purposes only. So for example, we've mentioned the 24% tax bracket. If you as a consumer say, call up Fidelity, whatever your custodian is, I want to move my holdings 10K to 10K, IRA to Roth. I'm moving that $10,000. That $10,000 conversion is going to be treated as ordinary income. You're actually going to get a 1099-R form for that year's tax year. And you're going to be taxed at the 24% tax bracket. So by doing this conversion, just keeping simple numbers, and for simplicity purposes, I'm not going to deal with anything on a state or local tax level. Moving $10,000 from an IRA to a Roth via Roth conversion, you would be hit with the $2,400 tax hit. Again, everyone's tax situation is different. Hopefully you all filed your taxes in April of this year. Maybe you need an extension because you're waiting for some various K1s or other forms. But, look at history. Look at what you've averaged the last couple of years. Have you typically gotten refunds? And essentially a refund is basically just a payment back that you overpaid the IRS. They're giving you a refund of what you overpaid. So, just kind of round numbers. If you talk to your CPA, maybe every year you're getting a few $1,000s in your retirement account, or excuse me, $1,000 as a refund. Maybe you're able to utilize the tax code to your advantage of, hey, maybe I can do a conversion, maybe $10,000 worth, $5,000 worth, whatever the dollar amount is, and take the tax hit and have that offset by what my anticipated refund is going to be. Then the benefit of that is that $10,000 moves from the tax deferred to the tax free bucket. Say you're the next Peter Thiel and you invest in the next PayPal, Facebook, Shark Tank investment, whatever the case may be. Maybe that $10,000 that balloons to $100,000, $1 million. Maybe you're the next Peter Thiel and have a $5 billion Roth account. Whatever that number is, you've done that conversion, you've paid the tax on the seed, and now you get to enjoy the harvest tax-free going forward. Now, before I brought up a couple of options here, what if you invested in Bitcoin and, you had $10,000 worth and it dropped to $5,000? Well, I've just kind of given a couple numbers. Now, your cost basis or what those holdings are worth is $5,000. What if you move that $5,000 now over to your Roth side? We talked about before with doing a conversion of $10,000, shifting from the traditional IRA to the Roth IRA at a 24% tax bracket. You'd be hit with a $2,400 federal income tax bill. But if that point in time, those holdings dropped to $5,000, since we cut that in half, now you're looking at a $1,200 tax hit or a 50% savings by doing the Roth conversion from traditional to Roth with the depressed value of that. And there's been a number of instances that this might have been beneficial. Now, I'll just kind of give a few examples that I've done and, shall I say, take advantage of in the past here. So years ago, I want to say, what was it, August, memory serves me right, I think it was August of 2016, they had voted what was called Brexit, or the British was going, or were going to leave the European Union, hence the Brexit. They were going to leave the European Union. And with that, there was a lot of volatility in the stock market and various stocks. There was more sellers than buyers. So it put a lot of downward pressure. So there was a significant downturn, even short term volatility in the stock market because of the whole Brexit. Now, one holding that I had in my accounts in my traditional IRA, and I think this was back in 2016 that the Brexit occurred. But for whatever reason, waste management hit. It was a good 10% decline over a couple of days. And a lot of this is just the overall market, that there was a huge selling pressure, correction, if you want to call it, bear market, if you want to call it. But regardless, for the Brexit, it had a over-encompassing impact on the stock market. Now, you might be thinking waste management, okay, they're generally here in the United States. A lot of their income is derived from the United States. They just, as the name implies, they manage waste, they manage recycling. I think it's pretty safe to assume they're not going to be really impacted by Brexit. But regardless, waste management was a stock that I saw a significant dip in my retirement account. So I called up my advisor. I said, I want to do a conversion. I want to move my waste management stock from my traditional IRA to my Roth IRA and take the tax hit now. And turned out to be a good play. And since 2016, waste management has grown quite nicely. They've also increased their dividend. And that stock has grown in my Roth IRA tax-free. I took the tax hit early on and should be there for another couple of decades and get those distributions out tax-free. Another example, if you remember from the Great Recession, Ford stock actually dropped to $1 a share. Back in my copier days, one of my customers, he actually bought up a lot of Ford shares when it hit $1, and that was one of his nice plays. I think he 10x, 15x, maybe even 20x his income, factoring, or his holdings, even factoring in the dividends. So, hypothetically, like I said, hindsight's always 2020. If we could get a time machine and go back to 2007, 2008, Ford is $1 a share. Well, let's just say, I don't know, say it had 100 shares. Well, maybe that was worth $2,000. Now it's only worth $100. That's a big hit for anyone's retirement account. But you could essentially turn a loss into a gain, utilize the tax code to your advantage, call up your broker, or maybe you can even do this online with one of your platforms and say, you know what, I'm going to do a Roth conversion. I want to move my Ford stock from my traditional IRA account to my Roth account. So I'm going to take the tax hit at the depressed rate, pay the taxes on the $100 market value of those shares. Like I said, hypothetically, I own 100 shares of Ford stock trading at $1. Move it to my Roth account. Years pass by. This goes from $1 a share up to $15 a share. Obviously, got the dividend payments throughout those time period. Now that 15x return now grew all in my Roth account tax free. Another example, maybe a little bit more recently, we had the COVID pandemic that hit early 2020. And if you're watching the Dow Jones, there was a huge correction in the stock market. I think it was early March, around the 11th or 12th. One of the all-time largest point drops of about 2,300 points, or a 10% drop in the Dow occurred. And that was followed up about not even a week later, I think 4 days later, that the Dow dropped another 13%, or another, I think it was about 3,000 points, as there was a lot of unknowns, a lot of uncertainty. What's this whole COVID pandemic? What's that going to do? How's that going to impact us? Generally speaking, the stock markets, they love certainty. They hate uncertainty. Whether it's a COVID-19 pandemic, the Great Recession, the bankruptcy of Lehman Brothers, the Great Reset, take any events over the last 10, 20 years. In the industry, they might call these as black swan events, once in a lifetime events or unanticipated events where, right, wrong, or indifferent, there's just a huge selling pressure and millions, billions, trillions of dollars can be wiped out in the stock market almost overnight. So with this, again, back to the examples, and this was one example that I personally partook in, was Boeing stock. Again, this is no stock recommendations, not financial advice. Be sure to work with your CPA, your financial advisor. This is solely for educational purposes. But with the huge, disruptor, because COVID's hitting us, maybe air travel is going to be down or pretty much non-existent, which it was for a lot of 2020 before the lockdown started easing up. Boeing was thought, they're going to get hit huge by this. And this is even before the MAX 737 MAX issues that came about in their new airplanes. But Boeing stock actually dropped from about $330 a share all the way to under $100 or about $95 a share. And this was just in a 1 month time frame from February of 2020 to March of 2020. So, just kind of keeping simple numbers here. Maybe you had Boeing stock at $330 a share. I don't know, let's just keep it easy. Let's say we had 100 shares and we had $33,000 of Boeing stock in our retirement accounts pre-COVID, COVID pandemic. And like I said, this dropped from about $330 a share to $95 a share, which I think pretty much anyone would say would be severely oversold. There tends to be an old adage with bear markets, the bull goes up the stairs and the bear goes out the window, basically just saying, what can take months or even years for a stock price to go up, it can basically backtrack or go down in a matter of hours, days, weeks, or a couple of months. But just for an example, Boeing stock, was trading at about $330 a share. If an investor had 100 shares in their traditional IRA account, that's $33,000. If we move that, did as a Roth conversion at $330, you might be thinking it's like, holy cow, 24% of $33,000. That is quite the tax hit. I don't know if I want to do that. I don't think I can even afford to do that. Pay the tax hit. That'd be roughly, just using round numbers here, you're talking about a $9,000 tax hit on the 24% federal tax bracket. But if it dropped to $95 a share, and those 100 shares are now trading at only $9,500, not even $10,000. Well, unfortunately on paper, okay, we just took about a 69% hit in less than a month on those shares. But what if we can benefit from this downfall or benefit from this correction, benefit from this black swan event that has impacted the stock market, send the Dow Jones 10%, 13%, 2,000-3,000 point moves? What if I take the tax hit? Excuse me. I'm just going to use round numbers here. Let's just say it was $30,000 worth. $30,000 worth of Boeing stock, ticker BA, dropped by about 2/3. That $30,000 drops to $10,000. And then I call up my broker or go online, go to my Fidelity, go to E-Trade, whatever my platform of choice is. And I decide to do a Roth conversion of those 100 shares of Boeing stock. Going to move the 100 shares from my traditional IRA to my Roth IRA. Now, instead of a tax hit, like I said, 24% on a $30,000 Boeing that the stock is worth. Let's see, that's about, I'm rounding up here, about a $7,500 tax hit. Kind of spendy. But, and again, this is timing a little bit, and hindsight is always 2020. I can't predict the market, nor can anyone. But, hypothetically, if we could go back in time, in you could do what I did with not 100 shares. I just had a few shares of Boeing. I moved that over to my Roth account, and it had gone down. We'll just round up to say about $10,000 worth. Now my tax hit is 24% on $10,000, or a $2,400 tax hit. I basically just cut my taxes by 2/3 by utilizing an overly sold stock at that point in time, moving that from my traditional IRA to my Roth IRA, dropping what I owed in taxes. And then whether it's Boeing, whether it's Waste Management, whether it's Bitcoin, whether it's Ford, whatever the holdings are in your Roth account, those now grow, compound, earn dividends, all tax-free forever. And when you hit a minimum age of 59 and a half, all those distributions are tax-free as well. One last note on the Roth accounts versus IRAs. I'm a big believer, life happens, things happen. I know the Dave Ramseys, the Susie Ormans, say never touch your retirement accounts, but sometimes medical bills, calamities, death, divorce, whatever the case may be, sometimes you just have to break open that retirement piggy bank. Not necessarily recommending it, I'm just saying life happens. Well, in a traditional IRA or a traditional 401k, there's some nuances, some carve outs that allow you to take out money or even loans out tax-free. But typically speaking, and going back to the 24% tax bracket here, let's just say you have $10,000 in your IRA and whatever, life happens, you got a big medical bill. It's like, I'm sorry, I just don't have the funds. I need to take that $10,000 out of my IRA, which legally you can. However, you are going to be taxed on that at 24%, and you're going to be hit with a 10% penalty. So $10,000, 1/3 of that is going to go right to Uncle Sam. So, not the most advantageous, right, wrong, or indifferent. The tax code is designed to discourage taking money out of your IRA early or taking it out of your retirement accounts for non-retirement purposes. Likewise, had you done this Roth conversion, and again, there's a few little nuances here. Everyone's tax situation is different. By moving it to an IRA to a Roth, you can take your contributions out anytime tax-free. Contributions in this case would be the $10,000 we've been talking about. That would be your contributions. If that $10,000 grows to $20,000, then you can take out your contributions tax-free. Your earnings you can take out, but then you're still subject to a 10% penalty, but you've already paid taxes on it with the conversion. So having an IRA, like I said, life happens, something happens, you need money. Maybe you just want to take it out of your retirement account. Maybe there's a investment opportunity that has returns above and beyond what you're getting in a retirement account. Maybe you just say, enough of this. I want to take this out of my retirement account. If you take this out of an IRA, you're going to be hit with your highest marginal tax highest marginal tax bracket plus a 10% penalty, or about 33%. If you take it out of your Roth, and now this is the earnings, then you get hit by a 10% penalty. You can take your contributions out anytime tax-free. If you follow my story or gone on my website, listen to my podcasts a couple of times, pulling money or my contributions out of my Roth IRA is how I started my real estate investing journey back in 2016. So like I said, if you just look down the runway and want to plan for the unexpected, pay the taxes now, pay it, lower tax bracket that's before it sunsets in 2026. If something happens that you need to take money out of your traditional IRA, would you rather pay 34% of that to Uncle Sam, or would you rather pay 0 to 10% to Uncle Sam? And then finally, in closing, we've talked a lot about IRAs here, but your traditional workplace plans, 401ks, more and more companies are starting to have a Roth component of this. So this conversion method that I've been talking about, If you're self-employed and you have the option to open up a self-directed retirement account, self-directed 401k, or solo 401k, the IRS does allow conversions from your traditional 401k side to your Roth 401k side as well. If you're working, a regular W-2 job, check with your employer, check with the HR department. As far as the tax code is concerned, a conversion from your traditional 401k to your Roth 401k is allowed. There may just be some, nuances in the custodian's 401k plan that they may not allow it, may not know about it. I've actually talked to HR directors that haven't known about this. So just do your due diligence, do some digging, talk to your HR director. Like I said, tax code wise, this is allowed under the tax code. If your particular custodian, HR, workplace does not allow for this, advocate for it, push for it. They might not know about this. So I just kind of give this as a general overview here on a Tax Tip Tuesday, that anytime if you have a traditional retirement account and you have a Roth retirement account, and for whatever reason there's a black swan event, a correction, an unrelated event that puts drastic selling pressure on a stock or a security or holding of any kind, whether it's a great recession, banking failure, a flash crash, whatever the case may be, doing a Roth conversion is a way to mitigate your tax bill. Take the tax hit now, take the tax hit at the depressed value, move that to your Roth side, have it grow, compound, expand. And like I said, that's tax-free income when you turn 59 and a half, or if life happens and you need to take out your contributions or your earnings. I'd personally rather pay a 0 to 10% penalty in tax versus a 33% or higher tax, depending on if you're what marginal tax bracket you are in. Could be even as high as 50%. I've seen that a couple of times too. So, like I said, this has been a method that's been around for quite a while. It's fully endorsed by the tax code. Like I said, make sure you work with the financial advisor, your CPA. Make sure you don't get moved into a higher tax bracket, maybe trigger some alternative minimum tax, maybe lose out on some deductions. Everyone's tax situation is different, but just wanted to bring a high level of a Roth conversion. Can be a very suitable trick and a tax hack, if you will, for this Tax Tip Tuesday. Be sure to hit that subscribe button, and I'll be back to you for another video on a tax tip or trick or another way to legally save money on taxes.